Hey, all right, everybody. You know, it kind of feels like Monday all over again, but here we are. It's Tuesday, and Tuesdays are the day that we do the introduction to options. We are on class number 4, but I've been continuing to run the book from the previous book. So if this is your first time, you would be starting at the front of the book. You just kind of want to work your way through it. There are videos in the archives, so you'll be able to back up and see what you missed along the way. There are plenty of places for questions, and when we're done, the questions don't have to necessarily be about what we covered today, and they don't have to be introductory. They can pretty much be about whatever. The main thing, though, is when I'm done with the introduction and I'm done with any questions that pertain to what we did cover, I'll kill the recording because we don't want the streams to be, like an hour, 2 hours long when we're just doing these introductory videos. So let me get a sound check, make sure everything is good. You can hear me, you can see the live stream, and we will move on from there. All right. So I decided that we needed to take a little bit of a detour after the last week or two, kind of just seeing the things in chat. You guys influence a lot of what we do here when it comes to the educational content that we create. We just kind of see what is being asked a lot in the community, where there seems to be a gap or a hole in our education, and then that's what we focus on, trying to fill those holes. And lately I've noticed that using the analysis tab on Thinkorswim and being able to read a risk graph of a trade that you've built is where a lot of people are struggling. And so I thought that for class number 4, this is where we would look. This isn't necessarily connected to the introduction of options. It is options. You would want to know how to use this risk graph just to see your trade, just to know like where your current P&L is, because Thinkorswim, it really doesn't do a good job showing us what our trade is when we're in something like a spread. And I remember when I was newer, I would open up a spread in Thinkorswim, and 2 days later, I couldn't remember, how much credit I had got for it, or, what my break even was, because I had a lot of trades on. I'm trying to juggle all of them. And when I would go hunting for the information, the platform really didn't present that information to me in a way that I was able to use. I found it very difficult to keep track of a trade. And along the way, I found that if I just went to the analysis tab, I would find my trade right there. And I would know what my break even was. I would know, how profitable I had been at this point, what I might need before I would be profitable. So learning how to use that tab and then being able to read a risk graph or an options graph is going to carry you a long ways. And while we might cover some features that are very specific to Thinkorswim, most of the things we're going to cover you'll find at a lot of brokers. Even Robinhood now has started to finally implement some form of a risk graph on their options. Took them a while, but they got there. So I don't sit here and read this. I've shared it early. It's yours. You can read it slowly at your leisure. I mainly want to hit the hot topics, the main things, and then pause, take questions, and we'll move on to the next thing. So when we're trading options, it always comes back to expectation. I mean, it really does when you think about it. What's my expectations of this spread? Do I think it's likely to be a winning trade? Do I expect price to run away like a freight train, or is it kind of going to linger around and sit on the bench for a while? What's my expectations? And then on the profit side of that, profit and loss, what's my expectation of risk? What am I going to be looking at if I put this trade on? So when we can visualize that, when we can physically see some picture form of what our risk is, man, that helps out a lot because we are visual people. I've noticed that A lot of us struggle if you only give us numbers. But if you give us numbers in a picture, it makes so much more sense. So we really just want to just start with a risk graph. Where is the zero line? Where's the profit side? And where's the loss side? Now on Thinkorswim at the top of the page, when you're in the risk graph, you'll notice it has probability of in the money. That doesn't change anything more than a visual representation of this gray area that I highlighted where the purple box. So if we choose out of the money, the gray will be where the blue is, and the blue will be where the gray is. That's the only difference. It would still be a 1 standard deviation. It would still be reflecting out of the money versus in the money, right? And if you know one, you already know the other because it all adds up to 100%. So if I've got an OTM of 40, then I got an ITM of 60 or vice versa. We only need to know one number to get the other one. So we can change that visual at the top by picking in the money, out of the money, or the probability of touching, which is a very useful feature for all of you who think you like a stop. The probability of touching can give you the likelihood that your stop is going to get hit. And then maybe you'll learn that stops aren't so good. Maybe you don't want to use a stop after all. So starting with a risk graph, we got the in the money, the out of the money drop down. We can go and notice here in the picture where now the gray is on the outside and the blue is on the inside. Before, it was the other way around. The calculation didn't change because it's using this number right here, 68.27. That's a 1 standard deviation. And a lot of things in trading use standard deviation, not just options. Keltner channels, Bollinger Bands, price rainbows, price bands, all kinds of things, volume profile. You will find standard deviation throughout the marketplace. And the sooner that you understand what it is, the better your trading will get. I never change that, by the way. I always just leave it in the money because I don't really care if it's in the money, out of the money visually, right? I don't care if it's blue in the middle or blue on the outside. I don't care. So I don't change it. You might have a specific reason that you want to change it. Fine, it doesn't hurt anything, but now you know that you can. You can go up there, you can click it, flip it over to the other side. It doesn't matter. What does matter is when you change the standard deviation. So a 1 standard deviation is what we would consider first gear. It'd be 70% of all trading activity, or it would be 78% or 70% accurate, right? So it can be said a lot of different ways, but it basically rounds up to 70. And we can say that all price action will stay inside of that 70% of the time. We can say that at expiration, price will land in that box 78% of the time, right? We can phrase it a lot of different ways. But what if I wanted something more accurate than 70? We can go to a 2 standard deviation. A second deviation would put us at a 95% probability. Now you might be thinking, damn, that's like very close to 100% accurate. And you're right. But a 3rd standard deviation, a 3 standard deviation would be a 99 point blah, blah, blah. So very close to 100. We don't want to get into a trade that has a 99.9999 chance of winning. I know that might sound really good if you're new to trading and you're new to options and you're thinking, but I want to win 99% of the time. That's what I want. No, you don't. You honestly don't. You don't want to win 99% of the time, and you don't want a trade that has a chance of winning 99% of the time. And the reason why, very quickly and vaguely, is because if you don't have any risk, you're not going to get any money. Why would anybody trade against you if they have to take the other half of 1%, right? 2 sides to trading. So if each side is equally risking 50% chance of winning, you're in a fair bet. If you have a chance of winning 95% of the time, that means I'm going to be winning 5% of the time. When I win in my 5% of the time, I should get one hell of a payout. And when you win 95% of the time, you shouldn't get anything. A couple of pennies, maybe a nickel. Yay for you. So without risk, you don't make any money. Well, one standard deviation puts us at around a 70%. And that means we're getting some money and we're willing to accept some risk without getting too deep, taking too much risk. So there is a clock at the top, like a calendar clock. And this is where we set the days. Whenever you reset your Thinkorswim analysis tab, make sure you check that date. That way, if you do build a trade, that date will reflect the trade that you built. So if I today build a trade for October 15, I would want to make sure that this calendar said October 15, or even 1 day later. That would be fine too. And the reason for the 1 day later, Thinkorswim recognizes that while an option expires today, it really doesn't get exercised until tomorrow. Right? There's all these laws and regulations that go into things. If it has today's expiration date, it really won't be settled or managed or dealt with until tomorrow. And so it's okay to go 1 day later on that date. Questions so far? And I know I'm kind of hopping through this a little bit, but this is just the introduction to options, and we got to get to the point where you can look at a risk graph and understand the zero line and where your profit is and where your loss is. So if there's no questions, we'll just keep on keeping on. All right, so what we're looking here is Apple with this really big purple cone. This purple cone is a 1 standard deviation, just like we had up here. That's a 1 standard deviation. Only difference is price here is on the bottom, right? And so the bell is going straight up and down. Whereas down here, we've got price on the side and the bell is going from left to right. It's still representing the same distance. It's just giving it to you in a picture that might seem more familiar to you. So now that brings us into how to read the risk graph. There is a zero line on the left-hand side, and then there is profit moving up from 0, and there is loss moving down from 0. Thinkorswim doesn't really color it that well, but a lot of other brokers do. So for an example, here on Amazon, if I build a trade and I throw it into the Analyze tab, you can see that it colored everything for me. Now this broker doesn't put P&L on the side, it puts P&L across the top. Doesn't matter, as long as we know where to find it, that there should be P&L somewhere, we can understand what's going on. At least on this platform, they color the profit side versus the loss side, and that helps a little with the visual representation. So there's a zero line, profit, loss, and the stock price is along the bottom. Now, if you look on Thinkorswim, there is an orange dotted line, and inside of that, right at the zero line, is a little dash that shows current price. I took this picture over the weekend, and Apple closed right at a 126 flat. And so that was the current price of Apple when I took this picture. And if you look at the top, there are 2 percentages there, 53.76, 46.24. If we add them together, we get 100. From price moving up, there is a 53.76% chance that price would hit the edge of the expected move by October 15. And there is a 46.24% chance that Apple would hit the bottom of the edge of the expected move, or the 1 standard deviation, by April 15, or excuse me, October 15. So once we stick a trade in there, things change just a little bit. I circled where the break even is on this trade at expiration. 33% is the likelihood of this trade being profitable by at least 1 penny at expiration. We don't really do things, quote, at expiration, right? We close things down early. We lock in profit. But there is a formula for POP, P-O-P, probability of profit. This one iron condor that I built had a 33% POP. To either side, the left or the right, it had a loss, and we can see where we go below the zero line. So if price outran me on the top side, 133.35, and it closed above that value, I would be in a losing trade. How far up past that value it went would be determined on how much I could lose, right? Same thing on the bottom side. Now the line does flatten out, so this is a limited loss trade. We know what a max loss looks like. There are some trades where it's unlimited loss, and the broker doesn't even know how to represent that to you because the loss is indefinite. Same with profit, unlimited profit trades, where the line just keeps going up and never flattens out. If we were to try to connect this line across the top over here to the side, we could try to pinpoint the exact dollar amount for the max profit. But if we were in a live screen, just stopping my mouse there in the middle, I could visually see what the max profit was in the trade. So what can we tell from the picture? And if we were to label these a little bit, we start to get an understanding of things. So the next time we go to put something in there, we'll have a better idea of what we're looking at. In red is the at expiration value. I already had talked about the pop at 33%. I talked about the little dashed line, which was current price. I talked about the downside break even, the upside break even, where I circled those lines. So if we were to put in a butterfly, a vertical, iron condor, it would still have these features. There would be break even. There would be pop. There would be current price shown in that risk tab, no matter what trade it is that you put in there. And next time you go in there, you'll now know what those things are. When you are on the risk graph, this is your opportunity to be able to change a few things. Fire up the other Discord. All right. So from here, from the current price, and notice that there is no trade in there, right? It's just a risk profile with no trade in it. We still have the gray box, and we still have the blue area. The gray box is representing a 1 standard deviation move in price from today's picture, the day that I took it, all the way up into the expiration date that I had set in the upper right corner. So between now and October 15, Apple has a 1 standard deviation move up to 145 and down to 106. And it's going to stay inside of that range 70% of the time. Or another way to say it is it has a 70% chance of staying in that range. Or you could say it has a 30% chance of breaking out of that range, right? There's so many ways that we can say it. And they would all be representing the same thing. Now notice it has a higher probability of hitting the downside than it does hitting the upside, right? They're not equal. These two numbers, when we add them together, come up to 68.27%. That's a 1 standard deviation within that gray area. Now, don't confuse a 1 standard deviation with an expected move. Those are two entirely different things. But we often talk about them like they are the same. So don't be surprised when you hear people blur the lines between those two. Even professionals, even I do it. And I'm not a professional, but I'm saying even professionals will do that, right? It's because we get complacent and lazy in the words that we use. Even me. So when we do put a trade into the risk graph, like this vertical trade right here, we can see current price with that little dashed line. We can see the current price with that price slice. The lower edge of the expected move, excuse me, the standard deviation, the upper edge of the standard deviation, the break even at expiration, and the current break even by the end of today or right this moment. Just keep in mind that that yellow line is an approximation between the bid and the ask of multiple contracts in a spread. So it is not perfect. It is not accurate. It is a visual representation of your trade. Do not ever rely on a risk graph to tell you exactly how much you made or lost to the penny, because it is never designed for that. Questions so far? Not yearly. It's based on whatever calendar we put in up here in the corner. So if I set it for October, it's a couple of months. If I set it for Friday, it's a couple of days. If I set it for the end of the year, right? So standard deviation is based on whatever day we tell it to be. And expected move is also based on whatever time we tell it to be. So here in the options chain, if I go over to SPY and we look to the far right side, you can see that we have an expected move between now and the next 3 days of $4.21. Well, that's a 3-day expected move. That's it, just 3 days. So when I'm in the Analyze tab, if I set that for Friday, then I'm also looking at a 3-day. But one is a standard deviation in the next 3 days, and one is an expected move in the next 3 days. One is based on the implied volatility within the options chain itself, and one is based on historical price action within the candles themselves, so off of the candle chart. If you want the nerd version, and the nerd version is very useful to have, we can actually spout the language right out of the book. Implied volatility is a statistical measure that reflects the likely range of a stock's future price change. That's implied volatility based on a candle chart off of a daily candle chart using a 1-year formula of implied volatility. And I think that's where you kind of got stuck with the yearly thing. So implied volatility indicator out here on a daily chart, this is using 1 year's formula to give you an implied volatility, and then that is used to give you an expected move based on price action. On what? Oh, yeah, I didn't get filled, so I canceled it. It had dropped down to like 90 or 93, and I canceled it. No, I didn't get filled. I canceled it. When I got home from out running around, it was down to like 90 cents, and I wanted at least $1. So when it dropped to 90 cents, I didn't want it to get filled at 90 cents. 90 cents isn't enough credit. Still a good trade. If I had gotten filled for $1, I would be happy to have it, but I didn't get filled. Remember, you got to buy it back to close. If you sold it for 90 cents or 98 and it went down to 93, you already made $5, right? And it's an iron condor. The idea being that we're looking for Walmart to stay in the box between 135 and 145. And that if it leaves that box, one side or the other, then we would be taking risk and we would need to do something about the trade. But that as long as Walmart stays inside the box, the trade is still good. So if you look at where Walmart is, it's still in the box. Doesn't matter that Walmart went down. No, not really. We're still expecting this support pivot to hold, and it still has a long ways to fall before it comes out of the bottom or the top of that box. It's fine. And every day that goes by, you want that thing to lose more money. So if you sold it for $1, you want to buy it back at like 25 cents, right? That way you made 75-cent profit. But I canceled my trade because I did not get filled anywhere near $1, and I did not want to open it for 93 cents. I didn't even like $1, but I was willing to do it because I was on mobile and it's a pain in the butt. So there is a difference between a 1 standard deviation move and an expected move. An expected move is a forward-looking mathematical calculation using the options implied volatility. That's a mouthful. Whereas a standard deviation is looking at what price has done in the past, measuring its close to close value, and then projecting a bell curve where the mean or the average is projected right in the middle, and then the edges are done from each side to where we get our 68% bell curve. It's a statistical formula. It's kind of a little bit of a head cruncher. Bell curve statistics. The easiest way to keep the two separate is to come out and load the cone. Just type in the word cone. That cone is a standard deviation bell curve, and it's based on price on this chart. Whereas expected move is right here in the options chain, and it's based on the implied volatility within each of the options in that options chain. One is forward looking and one is backwards looking. I had to learn bell curve statistical mathematics in college for psychology classes. And so for me, while I forgot the formula and I don't ever want to try to learn it again, I still remember the concept. So it's a good way to keep the two separate. By the end of today, you should be able to stick a trade into the risk graph and recognize where your loss line is, where the zero line is, where your max profit, your max loss, your break even. You should be able to recognize where all of those things are by the end of today. In part 5 or chapter 5 or whatever it is that we're going to call it, we will be continuing along more with the risk graph because we're not done yet. I wasn't able to get it all, or I would have ended up writing a whole book just on that in one weekend. So here I got out the colors and I made it a little prettier. made it look more like Tastyworks. Oh, sure. Yeah, at any time, which is why if you're already in a trade, it is sometimes easier to go look at your trade on the risk graph to see what your P&L is. Like this trade right here, I'm in XRT, and it's really hard to figure out how much credit I got for that. It's only a 50-cent wide credit, so this trade price of 0.00, that doesn't make any sense. I could try to do the math between these two numbers and come up with 25 cents. Looks about right. So if we squint at it and kind of look at it sideways, but we can also go to XRT. And we can see that there's my trade. And then when I go to the Analyze tab, even though I don't have a trade down here, I didn't build one and stick it over there to be analyzed, it is looking at my portfolio. So I can hide my position and now it disappeared. Or I can put my position back and there is my current trade. So there is my risk graph. And now, even though I've had this trade on for quite a while, and I honestly forgot all about it, I can bring it in here today and look at it and see exactly what's going on and be reminded, oh yeah, I forgot all about this thing. Hey, I'm profitable. Right on. That is great. And I will be profitable as long as we stay above 93, 60, 93, 75, something like that. If I don't move my mouse, we can see that I have a max profit of $25. And then if I come over here and I quit moving, we can see that I have a max loss of $25. It is a balanced trade, risking $1 to make $1. My current P&L is today, I made another $7.91. Yay. The total so far, I've made $13.48, so some of the $25. More than 50%. So it's really getting close to closing time. Now, the nice thing, and I haven't done all the things yet, but suppose I want to visually see this trade on the chart, right? I want to see this in the candles so that I can better visualize what I need out of this trade. First, I got to set these orange lines. Now, I can do it manually. I can just drag them around. But if you're handicapped like I am and you can't control a mouse really well, you can tell the platform to do that for you. So you just use this drop-down menu here. Set your slices. Base means price, today's price right now. So if I set it for base and then that little ampersand, that would be a 1 standard deviation and current price. This would be a 2 standard deviation in current price, and this would be a 3 standard deviation in current price. I don't need any of those. I need break even. Now it's asking, do I want break even for today or do I want break even at expiration? I want the at expiration. So if I do that, it will move the line right to the break even. Well, that's a good start, but I still need it on the chart. I can read the number and go put the line on the chart by myself, or I can let the platform do it. So now I go back to the same box, set slices to the chart, pick the first box in the window. There it is. That white line is break even at expiration. Now, I had already had a line there, but if I didn't, that's the line that it drew. And we know it because it's named price slice number 1, just like this one was named price slice number 1. It's this price slice right here. So if I go out here and I just delete everything, get rid of all the drawings, nothing there, we do it again, set slices, put it on the chart. There's my break even. And as long as price stays above that white line, I know I'm in a winning, profitable trade. So I can visually see what I'm working with. Now that's really helpful when you need price to go somewhere rather than, say, like in my credit spread, I didn't need price to move. I actually didn't need price to do anything, but it does need to stay up above that level. In the Walmart trade that we were looking at earlier, we could build that, throw the break evens on the Walmart chart, and visually see the box that Walmart would need to stay inside of for us to remain profitable. So it does all the work for us. That way we can take a picture and evaluate the trade later on, stick it in a trade journal, keep track of what we're doing. I like to have the trade drawn out onto the chart. I think it makes it easier to visually see what we need, and that makes it easier to understand when it starts to win or lose, because we can better gauge what we think we need out of price. If we go to build a trade and it's giving us some line way up here, and then it says, yeah, take this trade. It's only going to cost you $25 and you're risking $300. And all you need to do is get to that bot right there. Yeah, nah, no thanks. Never mind. I don't want it. Right? Because it's just too far away. So it helps a lot to be able to visually see our trade. When we stick it into the risk graph, you can change the colors. I changed mine to a red. That red line is the max profit and the max loss. If it's above the zero line, it's profitable. If it's below the zero line, it's not profitable. And then we always got to find the current price and ask the question, are we in profit right now, or do we need to move somewhere before we become profitable? So you can see if we had built that trade on Amazon, Apple, we were building it already in the money. We wouldn't need Apple to go somewhere for us to be profitable. We would need Apple to not go somewhere for us to be profitable. And believe it or not, when you're trading, it's a heck of a lot easier to try to figure out where we should not go. That's an easier target, right? Because when you're trading options, if you're buying calls or you're buying puts, you've got to try to figure out where we're going, how long it's going to take to get there, and then will we stay there once we do get there? Those are three things, and if you get them wrong, you're going to lose. But if you put on a trade that says, I don't think we're going to go above that, or I don't think we will land in this, well, that's a lot easier to trade. I will happily put on a trade that says I will be profitable as long as we don't get above $100, or that we don't get below $80, right? That would be a great bet. Pay me if we stay above $80. Sure. So trading where we think price won't go is a heck of a lot easier to do than trying to trade where we think price is going. And it's just as profitable. Now, the shape of these trades, so far we've seen an iron condor and we've seen two different verticals. A vertical that made money when price went down and a vertical that made money when price went up. It wouldn't matter which vertical it was, right? If it was a call debit spread or a put credit spread, they would both be long trades. A call credit or a put debit would both be trades that make money to the downside. What matters is how we entered into them, right? So when I'm taking a vertical trade, if I sell it, then I'm in a short vertical. It doesn't matter if it's a put spread and I sold it. I'm still in a short vertical because I sold to open, meaning I'm short a vertical spread. If I'm short a put spread, that means I'm long market, but I'm still short put vertical. The names can get very confusing, but when you're able to look at a trade inside the risk graph, it removes all of that confusion. It's either going to be shaped like an S or it's going to be shaped like a Z. A Z is a short trade, meaning the price is moving down to be profitable, and an S is a long trade where you need price to move up to be profitable, or to stay up or to stay down, right? Because a lot of these, we don't need price to do anything. So we hit on it already, but there are price slices inside of Thinkorswim on the analysis tab. You can make your own. You don't have to use the drop down, but you can use the drop down for a lot of things, like a 2%. So if I want to know where price is going, it has nothing to do with the trade that we're looking at either. We'll go back to Walmart. So if I'm on Walmart and I don't have a trade and I just want price slices at 2%, here's 11 rows of price set 2% apart. And I can set those to the chart. And now I've taken Walmart and I've broken it down into 2% moves from its current location, higher and lower. And I did it instantly. I didn't have to sit there and jack around and try to draw things and shaky hands and delete a line. None of that. And you're in control of what those lines look like. So here I have one of my old lines in hot pink. If I set that as the default and I set the name as showing and price as showing, in fact, I'm going to turn the name off. I like it off, but we'll show price. Save as default. Wipe all these out and then stick them back on the chart. Now I can see the price range for a 2% move from our current location, 2% higher, another 2%, another 2%, another 2%. So the risk graph allows you to do all kinds of things besides looking at your trade, which it also does that. So a 1 standard deviation based on price or the date. If I want to know how far Walmart can go by the 1st of next month, there's July 1 standard deviation, set slices to the chart. I now have a 1 standard deviation move of price marked with lines. I got rid of the middle one because that's where price is right this minute. 1 standard deviation between now and July 1. This is also a 1 standard deviation, but it only goes month to month. It uses the 3rd Thursday of the month, the expiration Thursday. So if we go in here to equities and we tell it, let's see, where is that? Time axis, show expiration Friday. Now you'll notice that that curved line, that bell curve, lines up with these red lines. So here's July 1. Oh, excuse me, July 16. And here's July 1 in hot pink, right? So we got 2 different standard deviations, one for the 1st, one for the 17th. By the way, you can go into probability analysis, and here again, you've got that same bell curve, but here you can zoom in and do it on a day-to-day, week-to-week, month-to-month, do whatever you want. And it still has your probabilities based in there too as you move your mouse. How likely is it that you'll hit 144 versus 136 between now and the 18th, right? Do we have a greater chance of hitting this lower number or a greater chance of hitting the higher number? So using these price slices, we can also just grab one and drag it all over the place. Wherever we set it, we can put that on the chart. we can come down here and choose different things. So if I want a 1 standard deviation, or if I want to do price as set, or if I want to just give it a particular value, we can make our own price slices, add a slice, add rows, reorder them, delete them. We can do whatever we want with these slices. And then when we're done, we can stick those slices on the chart. And they're just lines. That's all they are. They're just lines that we can mark out for our own amusement. Knowing that they are there gives us a chance to mark out our trade and then mark the same thing on a candle chart by using send to chart, right? Set slices, set them to chart. Real helpful when it comes to drawing out our trade. Notice also it gives you delta values, gamma, theta, vega, delta. It gives you P&L values, overall trade percent, trade on the day, buying power effect. So that's what I demonstrate in a couple of the different pictures that you can choose set slices, pick what you want, set them to the chart. Now, depending on how you have this set, in the money, out of the money, it'll give you these probabilities. So you can see from the current location in the trade that I have built here in this vertical, the trade had a 64.67% chance of being a winning trade. It had a pop right there. So a lot of people say that they like Tastyworks because it has your pop right here. So when we build a trade on Tastyworks, we can see the pop. You can see it on Thinkorswim too. Just like that. Now make sure when you're giving Thinkorswim commands to move the price slices that it actually does move the slices. It's a glitch inside of Thinkorswim that there are times where you will build the trade and then you'll tell it to move the slices and it doesn't move it all the way. It'll kind of move them a little and then they'll get hung up and they'll stop. So make sure they actually go to the spot that they're supposed to go to. Earlier today, I had built a Walmart trade using the 35.30 and the 40.45. That doesn't quite look right. Let's see what I did different before. July 9. Yep, same one. 135, 130. Yep. Oh, I had the 150, 145. All right, so let's bump that up. 150, 145. That is why the numbers were different. So right now it's worth 90 cents, basically. And I've got a couple of trades here, so we got to get rid of something. There we go. So this is the iron condor that I built on Tasty earlier today and was trying to get filled for $1. What was the likelihood that this trade was going to be successful and where was our risk? So the first thing I want is break even. And now from them break evens, I want to set them on the chart. So here's our Walmart trade, and that is the boundary that it needs to stay inside of for us to be profitable. Between now and July 9th, So for 1 month. Now remember, these red lines are 1 month apart from one expiration to a next, right? So from the third Thursday of the month, 1 month later, the third Thursday of the month, 1 month later, the third Thursday of the month. Sometimes there's going to be an extra week in there, which is why they're separated wider here than here. How long have we been inside of these two purple lines? 1 entire full month and almost an entire other month, right? So we got inside of these lines and closed inside of them in March on the 26th, and we've been in this box ever since. How likely is it that we're going to stay in this box until July 9? Pretty likely. And we don't need to stay there all the way until expiration. We only need to stay there long enough for us to be profitable, and then we close the trade, right? Because this is a trade that's going to decay in value every day that we're in it. So we were risking 4 to make 1, as opposed to a regular day trader's style where we would risk 1 to make 4. There's a big reason why we would risk 4 to make 1, where a day trader would be completely different, risking 1 to make 4. When you're making a binary decision about price, is it going to go up from here? Is it going to go down from here? I'm going to buy this. I need to be right. You're only going to be right about a coin toss. You have absolutely no idea where price is going to go in the next 1 to 5 minutes, not even 1 to 2 days. When it comes to destination over the next candle, destination is a lot easier to figure out. Well, when you have a very high chance of winning, you should not be paid as much, right? We covered that at the beginning. The analogy that makes common perfect sense. Think about going to the grocery store and buying yourself a lottery ticket. Now you know that you have a snowball's chance in hell of winning the lottery. And maybe you do it anyway. Once in a while, you go in there and you buy a scratch lottery, and you kind of shrug and you giggle to yourself and you say, yeah, I know, but what if I actually won? And it costs you $1. Or maybe you buy the more expensive one and it costs you $5. You don't even care, right? It's $5. You shrug. Oh, well, you gave it a try. If you were to win, oh my goodness, it would be a huge payout. But you have almost no freaking chance of winning, which is why, 1, it's a very, very cheap trade or a cheap gamble. And 2, you know you're going to lose 9 out of 10, which is why when you do win, oh my goodness, it's a winner. Well, when we come back to the options world and we make the same analogy, if your trade has a real high chance of winning, why would you expect to make a real high profit? Does anybody want to bet me that the sun will rise tomorrow in the east? If I'm wrong, I will give you $1 billion. And if I'm right, what are you going to give me? Since I'm the one with the trade that's most likely to win, I shouldn't make $1 billion every time I'm right. You should make the $1 billion every time you're right. Right? So this is a trade that has a very high chance of winning. And we have to risk 4 to make 1 to make it fair for the other person who's going to go against us. Because somebody else is betting that Walmart is actually going to close outside of these lines. And they are the one taking the bigger risk, not us. So if they win, damn, they should get more money. They took the riskier trade. So we risk 4 to make 1, and we have a very high chance of winning. And somebody else is risking 1 to make 4, and they have a very low chance of winning. It's still a good trade, by the way. I just didn't like the price. I would like to get at least $1. So when we look at that in the risk graph, we can see the gray shaded area is set for 68.27%. We already marked what our boundaries are for break even, we can reclaim those lines for ourselves. All we got to do is change their name, and Thinkorswim will leave them alone. So now that I've done that, I can actually go in and change where these slices are. So now I want my standard deviation. And I don't need the current price, so I'm going to delete that. Set those slices to the chart. So now we've got two sets of lines. How far Walmart could move in a one standard deviation move is in hot pink to the top side. And how far Walmart could move in a one standard deviation is set to pink on the bottom side. Our boundaries for our trade are in cyan, and they're very close together. And this was done on purpose. I wanted my break even very close to how far price could move 70% of the time, meaning this trade, it would lose around 30% of the time because Walmart's going to stay in those boundaries 70% of the time. And that's all the way to expiration. And I'm going to take some edge and close the trade early. So I'm going to increase those chances even more. But straight from the options, straight from price, looking only at a one standard deviation, which is in hot pink, that's how far we're projected to move. 70% of the time, we're going to stay inside that box. That's what we get when we use the risk graph. And then we can change the date at any time. So notice the date was wrong. This says July 1. This says July 9. So now we got to change this to the 9th. Go back in there, set slices to the chart. Now, that's how far it's projected to move between now and July 9. And we cut that a little bit. We're inside those a little more than we wanted to. Things have shifted around since I was building this earlier. But, yeah, is what it is. So when you build a trade, you can use these price slices for all kinds of things. You can use this risk graph to help you evaluate the what if of a trade. And next week, we're going to actually walk forward in time, and we're going to change the price of the market. We're going to walk into the future, change the implied volatility, and ask what happens to my trade if. That way you guys can start to evaluate which trades do better when volatility goes down, which ones do better when volatility goes up. What if you forget and then you have to come in and check? I build enough trades and I check it frequently enough. I've got a pretty good idea what most trades need. An iron condor, for an example, it does good when volatility goes down. But sometimes we build very complex things and then we just really don't know. Like, okay, earnings is going to be coming up. We're going to see implied volatility rising. What's going to happen to my trade if I take it and volatility goes up? I don't know. I'm going to stick it in here and find out. All right, so then you build your trade, throw it in the Analyze tab, move the volatility around, jack it up, drop it down, and you can visually see what will happen to your trade in the future if volatility goes up or down. You don't have to ponder like, well, gosh, I just hope it works out. No, we can go in and visually see it. I did have to put a limit on the book, though. I knew that if I wrote too much stuff, there would just be too much stuff to cover in a single day. So without, blowing your heads up like a watermelon, I figured this would be enough for a day. You'll be able to go back and catch the recording, watch it again. You have the book for the examples, so you'll be able to go in and build your own, or even take your live right now trades and go in and look at them. right? Like the one that I've got on that we were looking at earlier, XRT. I honestly forgot I had this trade. I knew I had it in there, kind of. I keep track of this portfolio a little bit. That's the beautiful thing about trade small, trade often. Trade small enough that it doesn't hurt, so that if you're wrong, it doesn't hurt. Okay? If I was to lose this trade, I would lose $25. I mean, I don't want to lose, but I'm not going to lose sleep because I have a $25 trade on. So now that you have gone through this material, take a couple of your trades and look at them on the risk graph. Spend time in here getting comfortable with it, and don't worry, you can't break it. If you come in and you're pushing buttons and you get it just all completely out of whack and you're like, oh man, what did I do? I broke it. Just go up to the top, hit the reset button. No harm, no foul, no problem. Also, don't forget, if you go in here making a bunch of changes on XRT, and then later on you go and look at Tesla, some of those changes might still be there. So it might be beneficial that you start the process every time by hitting that reset button if you know you're going to be in there jacking around. One more thing while we're here, and then I'll take questions and we'll shut this live stream down. When you're in here, every single time you analyze a trade, Thinkorswim keeps it in case you want to look at it later. Think of all the trades you may have analyzed since you started trading. They are still in there unless you've cleaned them out. So if you go to Portfolio, Beta Way, you'll notice that there are trades now down here, and there might be a lot of them. So I want to tell this to hide my current positions, and now I know that everything left is simulated trade, something that I built and looked at. You can delete that stuff and help your Thinkorswim out a little bit. The delete is on the right side in a little yellow X, and it might take you a while. There we go. Now I can see my beta weight portfolio, benchmark it against SPY. And now I know exactly what would happen to my account if SPY was to go up or if SPY was to go down, and by how much. Beta weight. We'll get deeper into that. Trust me. It's valuable and useful to benchmark your entire portfolio against SPY so that you got a really good idea of what your natural risk is at the moment. But for today, we really just wanted to come across these risk graphs, how to read it, how to make slight adjustments to the in the money, at the money, out of the money price slices, put them on the chart, and be able to visually recognize break even, profit, loss, zero line. So any questions? All right, guys, I know that this is introductory material. And for some of you, you might be thinking this is really the most basic, boring stuff you've ever heard. But we all have to start somewhere. And there are people within the bullish bears who want to trade options and haven't learned very much about them yet. And this is really for their benefit. But every day, I learn something new about options. I don't know everything. I don't know anybody that knows everything either. There's always something new to learn. The main thing is getting to a plateau, to this flat spot where you know enough that you know more than the person to the left of you and the person to the right of you, because you are trading against other traders. None of us can compete with Susquehanna or with one of those big institutions. We're not even on their radar, but we are trading against each other. So you want to make sure that you're the smartest person in the room when you're going in there trading. And while you are learning this stuff and somebody else is just snatching up day trades because it's the only thing that they know how to do and they don't have anything else in their toolbox, then you're getting ahead of the group. Once you get to a spot where you're able to find answers to a question, there's nothing you won't be able to do. Because options, once you get to a certain spot, they just become as common and normal as your own living room. They're not complicated at all. It's the language and some of the funny tools. When you get that out of the way, it's nothing. It's basic. Very simple and easy. So next week, we're going to dig a little bit deeper into the risk graph, and then we'll continue back on track with regular options talk.